Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending August 7th, 2020. I'm Preston Brenton. Thanks for tuning in. Remember guys, we don't want to be rat brain traders. We want to be the red striped zebra. And this week's theme, thought appropriate, Hickory, Dickory, Dock. For those of you that remember some of your nursery rhymes, the mouse went up the clock, clock struck one, mouse fell down, and then all shit broke loose. That was just my ending, not the nursery rhyme ending, but it was close. Let's take a look at the markets and see what's going on this past week, and then we'll kind of just take a look at where the path could go for the next week and several months. If we take a look at the market performance, if we look at the U.S. index, you can see that week for the week, everybody was in the green. Dow, S&P, Nasdaq, Russell, all in the green, with the Russell leading the way at a whopping 6%. But it was a very strong week. The Dow was also up over 4.3%. Year to date, the only ones in the red right now for the year to date is the Dow and then the Russell, but they're all making up ground. But look at Nasdaq, it's up 22.72%, really amazing. Now, if we look at some of the valuations and volatility, you can see the PE trailing ratio still around 31.9, forward 12-month PE ratio 25.45. It's lower by about 20%. But as I told you guys, with the interest rates as low as they are right now, well, guess what? You're going to have higher elevated PE ratios. You got the dividend yield coming in around 1.9%. 10-year treasury at 56.2, the way we closed this past Friday, and then the spread between the two around 136. So that's still a lot. And the current VIX closed the week down from prior week 9.91%. It closed the week at 22.21. So all in all, it was a really healthy performance. But with all the money in the market sloshing around with interest rates as low as they are, I mean, we can expect elevated PE ratios. Okay. Now, if we look at the sector performance, both the best and the worst sectors this week managed to finish in the green. The best was industrials, XLI coming in at 3.93, and the worst was healthcare coming in at still 88 basis points. And if we look at the annual performance, obviously the best sector for the year so far is technology, XLK, up 21.34%. And energy bringing up the rear dramatically at 39.61% minus. Okay, it's really, really bad. Now, if we look at the world index, we can also see across the world just about everybody on this planet. Well, the major indexes from the FTSE, which is London, the CAC 40, which is French, the DAX, the German index, the Nikkei, China, and Hang Seng, top to bottom. You can see weekly, the only one that came in the red for the week was the Hang Seng. But if you look at the year-to-date performance, really the only one in the green is China. The Chinese Shanghai index, it came in 9.96% for the week. So if we just look at global performance, we can see so far we got the S&P up 3.73 roughly year to date. We got Nasdaq up 22.72, so it is outperforming everybody. So it's a little wonder that a lot of money just continues to spread into the U.S. markets, primarily technology. I mean, that's kind of what we're seeing, right? So if we come over and just kind of take a look at the weekly sound bites, we're seeing stocks extending the gains, as I said, from the previous week. Nasdaq set another record, over 11,000. And we're seeing some better than expected economic data, right? Improved trends in the U.S. coronavirus cases are going down. They're still elevated, but it is going down. Business activity for the services sector expanded. We also saw this past Friday, the U.S. added 1.76 million jobs in July, coming in slightly above estimates. When you dig into the numbers, it doesn't look as strong as the initial top line numbers show, but still improvement nonetheless. Okay. But we're seeing gains in employment while they're still moderating a little bit. And it's showing in the recovery of the labor market. There's still a long road ahead. Okay. I mean, it's just going to be a long slog. And despite the better than expected reports, the job market really is still burdened by this complete shuttering of the U.S. economy. And we did see the unemployment rate come in from a record high of 14.7% this past April to finish around 7 or 10.2 this latest reading. Okay, so that's kind of what we're seeing, and we're getting this slower economic recovery. The timeline's going to extend out as far as when we can do this. We're going to see some more government stimulus, but there's some issues with that, as I'll talk about in a minute. The dollar index has fallen about 4% since July. Real yields on the 10-year are negative, and they're down a minus 1.10%. That's the lowest it's been in over the past 30 years. It's really amazing. So that's kind of gotten the gold bugs out, I guess. And I've heard it said, and I think it's said really good, especially for those of you that are living in the southern part of the Americas. You understand the cicadas. They go into hibernation for up to 17 years. So it's kind of said that the gold bugs are like the cicadas of the investment ecosystem. I saw that in Barron's. I thought that was really kind of funny. They hibernate for years and they come out and emerge in a buying frenzy. Then they go back into hibernation again. So gold has got a number of things going for it. I'll show you the charts here in a minute. Okay, so that's a little bit about what we've got going there. Now, precious metals, speaking of gold, it's rallied about 17%. It reached an all-time high this past week, a little over 2,063 or so before kind of pulling back just a little bit. But, the gold rally, we're seeing a lot of that with the coming and the already existing government stimulus, right? And the fear of a possible spike in inflation. But I think a lot of the gold rally is basically on the low inflation and the negative real yields. I mean, if you run the chart and inverse the chart of real yields, which is current interest rates on the 10-year less the inflation rate, you're getting a negative number, and that's what's driving gold a lot. Okay, now also we're seeing this stimulus package, as I said, the Dems and the Repubs are kind of at odds right now. They're wide apart, as evidenced by some of the reporting this weekend. So Trump's already thrown out a tweet or two saying he's standing ready for executive action. So we'll see how that pans out. I don't know what the details are. I don't think anybody knows the who, what, when, and where of the money and where it's going to go. We're going to see. But that's obviously going to play a big, significant role in price action for the coming week. Okay. Meanwhile, Trump has put a TikTok deadline on TikTok and WeChat, both Chinese apps, right? They're kind of in the next 45 days, I guess, is going to be considered persona non grata in the U.S. So keep in mind that that could influence Apple in the coming weeks if this does go down, because I'd read a report that about 20% of the iPhones in China have WeChat, and there was a survey done that said, would you give up your iPhone or WeChat on your iPhone? And they said they'd give up their iPhone. So that could actually hurt Apple a little bit more than intended. But we'll see how this thing plays itself out. But Trump is okay with the Microsoft acquisition of TikTok. And analysts so far are placing odds of an acquisition at about 75%. As we guys know, anything can happen in any kind of M&A activity, especially something as quick and as abrupt as this. But Trump's got a red phone right to the CEO of Microsoft. So, and I know Microsoft, it could be a good deal for both, which has kind of moved Microsoft higher. We'll see how that plays itself out. And if any of you haven't forgotten, we're still kind of winding down Q2 earnings season. And we're getting, so far, 84% of the companies have reported. And the average beat rate is still at about 22%. And that's higher than the 5-year average of 72%. In fact, that 22% beat rate's the highest beat rate we've seen since measurements started over 30 years ago on earnings. And probably even more important than that is that the Q3 estimates for earnings are actually moving higher for the first time since the first quarter of this year. So all of these things kind of lead up to the market's starting to stabilize. And then if you put all the stimulus behind it, guys, as I've been telling our members, you have to fight the urge, but it can go higher. Okay, we can go higher. Now, what I want to do is I'm going to shift you over to another screen over here. So let me just take you over to this screen right here. And I'm going to show you a Ichimoku cloud chart, daily chart, and you'll see a colored bar at the top, and that is the anticipated next resistance zone if we take out the 33.9750 roughly, which was the highs that were made back over here in February. And you can see this move up here like this, just dramatic. Now, that does not mean that that's where we're going to go near term. I think we're going to kind of run into some resistance here around the 3,400. I think near term we're going to pull back a little bit more, and then we're going to make another run. And that next run can take us up well beyond 3,400. And it could literally take us up into the 3,600 range, believe it or not. Okay. And I know it's kind of hard to believe given the current market dynamics, but that's what the charts are saying, guys. But right now, near term, the charts are telling me that we could pull back. Now, if I look at if I give it another swing, but let's look at another chart here. What you're going to see here on this chart, and let me just kind of just flip this around just a little bit and get it back up to speed here. You can see right here the 2019 closing price. I had an initial target here for our members of around 33.10. Okay, and I put this target on here. By the way, I put the target on back around early June. I had all of our members going long early April, and then we picked up some puts here for this down move, and then we got long again. We picked up some puts for this small little move here, but this has been my target. Okay, and as hard as it seems to believe with the markets the way they are, that's been the target. Now, if I take it out to, let's say, early April, which is when we just started going batshit crazy to the long side. Look at all that volume over price sitting right around the 32.36 area. That is going to be a support point on a pullback right around 32.36. I mean, the markets love to find these popular spots, and that's popular just because above that line we're green for the year, below that line we're red for the year. Okay. And then slightly below that is another pullback point of 31.35, which are just fib nodes. These are fib extensions off the low here. Okay, so this is kind of what I'm looking at right now. Near term, we've got just a ton of momentum. You can see just constant green candles here. You can see any attempt at a sell-off intraday. I mean, let me just increase the size of this chart so you can see the candlesticks. You can see the long tails on these things, right? And that just shows that intraday, sellers have tried to take it down, but buyers just come in towards the end of the day and take it right back up again. These are bullish closes here, guys. And you can see on the MACD here, on this near term here to here, there is no divergence. So any pullback could be slight, a little bit of a pullback, but we're still in a buy the dip mode, guys. I mean, that's clearly what we're running right now. Now, if I shift over and show you the Fang Index, because I've got a Fang Index that I want to just kind of show you guys. Let me get this off the screen here, and I got to move it to another screen. Let's get this over here like this. And we'll get that on here like that. We'll get the Fang Index up for you. Let's see here. We'll move it over. I got so many monitors here. It's like trying to drive a car with a rear view mirror. So what I'm going to put up here is a special index that I've created and weighted, and I'll show you the stocks that are in it as soon as it paints the screen for you here. I've put in this thing, Microsoft, Facebook, Apple, Netflix, Google, and Amazon. And Google, I think I'd said too, yes. So you can see here that we actually came up and we hit a high of 15,593.07. So almost the all-time highs that were made on these FANG stocks a little bit earlier, right? Almost all-time highs here. So, we've got that kind of setup. And when you have that, it's really cool because you can see the MACD is starting to roll over here, which would set us up for pretty good little divergence. And that divergence can take us right back down to this area down here. My original call was for it to come down to around 14,000. And that's when we came right, because I was calling for that drop. And we came down right below. You can see the movement on that candle, and we closed right up above it, and we kind of sat just above it before we gapped up again and took off. But I think we're going to come back down and test this area. So now the key with the markets is, are other stocks going to take over and run solid, or is the market going to pull back? I believe the market is going to have a little bit of a dip. It's going to be a buy the dip opportunity, but that's kind of what I'm seeing. Okay. Now, if we come over and let me just put it on the let me just come over here like this and show these things right here. If we look at volatility, all right, and if we look at the VIX, you can see here we're now getting ready to move into the yellow zone in the VIX. Not quite. We dipped in on the 6th of August on Thursday, and then we moved back out, and then we're kind of sitting right around this level here like this. Any dip, vol is still sensitive. We'll jack up pretty quickly, and then it'll kind of run sideways for a while. And I think the stimulus package, if the Republicans and the Democrats fight it out early in the week next week, and then Trump does an executive action, I'm really curious to see how the volatility is going to play itself out. It's going to stay elevated until that happens. And with that stimulus, if it does hit, it's always good to move markets up a little bit because we've got the momentum there. But after everything clears, we could have a little bit more of a pullback. All right. But again, we're still in a buy the dip. And if we look at the 10-year interest rate here, you can see on this 10-year interest rate, we've come below. Well, let's just zip out just a little bit. You can see on this 10-year interest rate, on this chart right here, that we're and this is a daily chart, okay? So we're sitting here and we were in this tight range. We're going to kind of move back up in this area here. So we're kind of just, I don't see too much more downside in the interest rates, okay? I don't see a lot of upside either. The Feds are going to keep it pretty much the way they've got it right now. And you can see that as evidenced by the bond market. If we look at the bonds, we've been in this tight range for a long, long time, okay? And if I just, let me just get this off the screen because that'll drive me crazy. Let's get it back up here like this. So you can see in the bond market, we've been in this tight range. Every time we get up near the top here, I'm recommending to our members that we just pick up some puts in the bond market or short bonds, or just do some really interesting trades that I talk about in our option masters on bond futures and options. And there's some interesting ways to play this, but it really makes for an interesting higher probability trade. I don't see bonds ripping much higher because I don't see interest rates going much lower, but I don't see bonds going much lower either. So it's a kind of a stable trade, and it's been this way, since early April. Now that the Feds have taken over as much as they have, not only in the U.S. but over in Japan, we're seeing it in China, we're seeing it all across Europe. So and over in the U.K., I think we're going to kind of run steady there. All right. And of course, if we look at the currencies, with the dollar, as you can see, we bounced up in the dollar. But as I've been telling our members, any rally, we're in a sell the rally kind of attitude with the dollar. Okay. Any rally that moves up, sell the dollar. And if you can't trade the dollar, you can do UUP, Uniform Papa. It's an ETF that tracks the dollar. Okay. But an even better play, because you'll get more premium if you want to use options, you can go into the euro. The euro, we're buy the dips, right? It's just the opposite. You can see there's no divergence in this. So it'll probably, if it comes down to this shaded zone, the time I get a trigger for it to go long, that would be a nice long in the euro. And the way to play that is FXE. Foxtrot, X-ray, Echo. All right, so it follows the euro again. There's no divergence. So if it comes down and kind of hits this area right around here, and I'll mark it for you, you can see where it gapped up right in this zone in here. It'll find support, and then it's going to come back up and make new highs. All right, that's kind of how I'm seeing this thing play itself out. And of course, if we come down, and I talked about it before, but if we look at gold, a little bit of a pullback. Right, but you can see it made highs, 2020 highs here, 2089 right there. It made that on Friday, but that's a bearish engulfing pattern on that candle right here. Okay, so you can see, I can see this coming back at a minimum down to probably 2,000. It's kind of a psychological number. That's a good little ways down. And that would mean the dollar's going to, and that would go in line with the dollar where it's rallying just a little bit. and gold is pulling back a little bit. But we're clearly, with gold, we're on the buy the dip. That's what we want to do. We are in the buy the dip mode in gold. But again, as I've told our members, we've been long silver. And look at this right here. I haven't even updated this one, but if I update it, silver on a return on capital basis has been so much better than gold. You wanted to be long silver. The 2-decade average for silver to gold is about it takes about 60 ounces of silver to make 1 ounce of gold, but the lately it's been running 90 to 110 ounces of silver to make gold. So the ratio just got too far out of whack. So all silver is doing is playing catch up. And all we're interested in our group is return on capital and where can we make the most money for the least amount of risk. And you can see, yeah, being gold has been good, but being long silver has been even better. Okay. And if we come into gold, as you can see here, I'm gonna zip it out a little bit. What I'm gonna do is I'm gonna go out to a weekly chart, and I'll show you where we originally, my first long call on gold. If we just come back here a little bit, right in this area here, right? You can see on that ascending triangle right here. You can see that break was the first call I had on long gold back on June 3rd, 2019. All right, gold has been in this ascending triangle and it finally broke out there. Now we played that, but we didn't play gold. I had recommended silver. And that was the time I said, let's load up on silver contracts. All right. And that was around the 17th of June. And if we look at silver around that time, I mean, look at this weekly chart of silver. Look at that catch up. Is that crazy? I mean, it's just insane. And if we look at this back at that time, right around 2019, that was right in this area here. All right. Right around here. Let's just get it in here like this. It's on a weekly chart, so it kind of spreads itself out. So right around here, when silver broke out of this level right here, right around 15 or 16, and now it's at 27. It's $5,000 an ounce or a point in silver futures, and it's up about 12 points. All right, now 5,000 shares of SLV will get you the same thing, and I had recommended for our members that don't. Silver futures is a big contract, so you could break that down into 1,000 shares of SLV or 100 shares if you got a small account, but a return is a return, right? And then we booked profits before the fall here. We had puts in it and had nice profits, and then it took off again. But you still wanted to be in silver versus gold. I mean, it's still that case right now, right? The other one that we did on this pandemic was right here. And if you look on this chart, on this weekly chart, we got long copper. And this is Freeport McMoran, and I've recommended this to our members. There was a list of about 10 stocks that I said, guys, we got to go long. Hold your breath and go long. And it just took off. And if you look at copper futures, we have members that went long copper futures, and you could see in the copper futures the same thing. I mean, this thing just took off, right? Boom, away we went. This is the buy the dip, guys. Even in copper futures, Freeport McMoran, and gold, I can see it going higher. Now, eventually, these cicadas are going to go back into hibernation like the gold bugs are. But I think near term, as long as that nominal yield is below zero, we're going to see this kind of evolution play out. Now, if we go look at oil, oil is just running flat. It's been, and this is a weekly chart, but what I'm going to do is come back in and put it on a daily here for you. And if we look at the daily chart, look at oil. It's just been, in the 38 to 43 range. It hadn't played this flat and this nice for years. And that's because OPEC is trying to get in balance the oil supply and demand. I think there's going to be a demand problem here coming up over the next 90 days to 6 months. And we're going to see oil back up in the 50s and 60s because all these oil companies have stopped a lot of production. They've cut back on the fracking, and you can't just turn these things on and off as quick as you would like. Fracking is a little bit quicker, but even then, we're seeing a lot of these companies just having big time issues. So that's going to create a demand squeeze with the current supply that we've got, which would be undersupplied. Right now, we're running over the 5-year average of inventory levels, but that's going to be wiped out, guys, over the next 6 months or so if the economy does turn hard, if they get a vaccine, and you're going to see oil come up. But for now, we're in this tight range, which I like. And if we look at Nat Gas, again, our strategy and our trade has worked nicely. Look at Nat Gas. It took off. We've been doing bull put spreads underneath Nat Gas for quite some time, and it's just worked nicely. You can see right here in this range for Nat Gas right here. Once it's down at the bottom down here, you want to be just doing bull put spreads. Basically, you're doing credit spreads out of the money, looking for Nat Gas to either stabilize or go higher. Now, up at this level up here, I would not be doing a bull put spread because the odds favor Nat Gas to pull back a little bit. It's very difficult for Nat Gas to get up here. The reason why it's running right now is a lot of wells are shutting down. So we're going to see, just like oil, we're going to see inventory levels start to become stretched in Nat Gas. But markets and the futures markets always anticipate this. So this is what's happening. And by the time the common retail rat brain trader jumps in, it's already made the move. You've got to get your mindset on the red stripe zebra approach, which is what we do. We follow this stuff and it gets us in a lot earlier. All right, so this is kind of what we're looking here. I would not chase that move as it sits right now. Okay, so that's a little bit about what we got coming up, guys. Members, I will see you tomorrow night, Sunday night. We'll go through some stocks. We'll look at some things that look pretty cool. We'll kind of take a little bit more of a deeper dive on the markets in the coming week. Otherwise, for everybody else, have a great weekend. If you're not in our group, love to see you come in. We're having a lot of fun. We're doing well. We're outperforming the markets. We've got strategies that work great in this kind of environment. Have a great weekend, everybody. I'll see you guys later. Ciao now.